Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day everyone. Welcome to the Bert Salazar Retirement Show. My name is Bert Salazar, and I am going to be the host for you this week, as I am every single week. And I'm excited because today is actually episode 170. So the fact that we've been doing this for now almost 3 years, actually a little bit over 3 years, and getting all of you to participate and be part of it. And I continue to receive a lot of feedback and emails and telephone calls and so forth. So that gives me the ability and the pleasure to continue to bring you good information that all of you can take with you and knowledge in order to better your retirement world as you move forward into your retirement life. So the title for this episode is Retirement Success, Stop Doing Business with the Devil. So I'm going to go into a little detail as to what I consider to be retirement devils that all of us need to pay attention to. So what are some of the retirement devils that you may think that surround your investments, your retirement accounts, and your retirement life? Well, in many ways, we have actually talked about each and every one of them, but I just want to give you a different perspective on them. And then I'm going to kind of talk a little bit about the last 3 rounds of life. Like if you were in a boxing match and you know that the last 3 rounds are the most important rounds if you want to win that boxing match. And the same thing happens with your retirement life and your life overall. And then last but not least, I'm going to touch a little bit upon provisional income calculations in retirement. You know, the good, the bad, and the ugly when it comes to them, because retirement is a very complex subject matter that the vast majority of clients that I engage for the first time have really not paid attention to, because either they're too lazy to do any type of work, or they're listening to somebody in the next cubicle that just is about to retire. Then, he or she is going to try to figure out what is applicable to one person and whether that's going to be applicable to that person next to them and so forth. But at the end of the day, what I find is that most people, if they have the time, the inclination, and the education to move forward into retirement and to prepare for retirement, they're going to be successful. The challenge is that, most of the people that I engage that are very close to retirement are nowhere near where they should be from a preparation standpoint. So what are the retirement devils? Obviously, you've heard me say this before, financial fees and charges. I did the previous podcast, I think it was podcast 169, I went into in detail into financial fees and the fact that they have a tremendous impact on your retirement account, to the point that it may represent a 19% booby trap on your retirement assets, because 1% fee is actually a 19% drop in your retirement accounts, and most important, in your retirement income. So financial fees and charges are very important. You need to pay attention to the bottom line and make certain that you can reduce those charges accordingly. Taxes, obviously, that's a big one. And as we move forward into the future, I think it's apropos to understand that taxes are going to be much higher than they are today. Inflation, there are 2 types of inflation. You have your traditional inflation, which is very high in the United States today. I think as of December of 2021, it was sitting at 7.5%, and that's the highest we've had in decades in the U.S. And there's also the personal inflation, which is the one that we'll talk about in the next few minutes. Account volatility. Your retirement accounts are going to go up and down, and then that's understandable. Now, the impact of the up and down in your 20s, 30s, and 40s are not going to be as acute or as hard as they're going to be in your 60s, 70s, and 80s. So the older you get in life, the more guarantees you want on your retirement accounts. The challenge with many of the clients that I engage for the first time is that most of their accounts, if not all of them, are in volatile accounts, which means that you can make a lot of money today and then lose a lot of money tomorrow. And then if you lose a lot of money tomorrow and now you're in retirement and you need to start taking distributions out of those accounts, then not only is that going to depreciate the account value, but it's going to be a double-edged sword, because not only do you have to take income out of those accounts, but also those accounts are losing value because of stock market volatility or interest rate volatility. So as you get older into retirement, you want to make certain that you can manage volatility properly. The way I try to explain it to my clients is that, take the number 100 and then deduct your age. So if you're 60 years of age, then that means that 60% of your assets should be in guaranteed non-volatile accounts, and then 40% of your assets should be into more growth-oriented or volatility-oriented accounts. If you happen to be 70 years of age, then again, take 70 from 100. So that means that 70% should be now in guaranteed income-producing accounts, and then 30% can be a little bit more volatile. And as you move up the ladder, obviously the volatility drops tremendously. Now, the last of the five retirement devils that I want to touch upon today, because we've talked about financial fees and charges, taxes, inflation, account volatility, is propensity to consume. And this is what I call your personal inflation rate. Now, most of us, or I would argue that most Americans are spenders. Very few Americans on a percentage basis are savers. But once you enter into retirement, you have to really pay attention to your propensity to consume. Are you going to be driving a $100,000 automobile or an $80,000 automobile? Or are you going to be driving a $40,000 automobile? Now, all of these three automobiles can take you from point A to point B. I think the challenge and the question is, well, which one is going to get you there more comfortable without jeopardizing your retirement? Now, if you're wealthy or you're in the upper middle class and you can afford an $80,000 automobile, well, that's good for you. But I would argue that most Americans are not in that situation. So managing your personal inflation and your propensity to consume is very, very important. Like, for instance, I'm one person that when I purchase an automobile, I want to keep it for 10 years. I'm not the type of person that is going to be trading my cars every 2 to 3 years, because at the end of the day, there's an opportunity cost there that I rather put somewhere else. So I'm always going to drive my cars, and I usually buy them and I keep them for 10 years. Now, I have had cars for 15 years. I do take care of my vehicles, and then obviously I may just pass it down to either a family member or someone that may need it, if I'm now at a point where I'm going to purchase a new one and so forth. The other thing I do with the financing is, I try to pay for my vehicles over 3 to 4 years. But whatever that financing cost is, once my vehicle is paid for, I continue to send that money into a side account because I want to make certain that I can accumulate enough money in that account that when it comes for me to purchase the next vehicle, I would have sufficient assets in that account to either pay for the vehicle altogether in a lump sum, or it would allow me to help offset the inflation cost in the vehicle from 1 year to 10 years down the line. So, that's important for all of us. And again, managing your retirement income, managing your retirement distributions, managing your taxes and inflation and volatility are very important if you want to achieve financial independence in retirement. So I have also talked about the last 3 rounds of life, and those are your retirement three rounds. So basically, you're going to work. Most of us are going to work till age, 65. Then we're going to decide to retire, and then I kind of factor in 3 decades in retirement for all my clients. Now, some of my clients may not get to, the third decade, but I plan for 3 decades in retirement. And if you retire at 65, I call those 3 decades, the go-go years, the slow-go years, and the no-go years. The go-go years are between 65 and 75. You're still young, you're still healthy, you're motivated, you may be working part-time, although you're already retired. Some of you may be totally retired, or some of you may retire, but you may want to start a new business because that's been your dream or your goal or whatever it may be. So between the ages of 65 and 75, you're going to be on the go. You're going to be doing some traveling. You're going to play catch up to the things that you couldn't do while you were working. So you may be spending as much money in your go-go years as you did prior to retirement, sometimes even more. And the reason for that is once you hit retirement, then every day is Saturday night. And that's a night when you get to have fun and enjoy. Now, if you live in Europe, like in Spain, then every day is Saturday night because in Spain, everybody's out every single day and with friends and having drinks and going to the local tavernas and having beer and wine and food, and it's an ongoing thing here. Nobody waits until Saturday night to go out in Spain. Everybody goes out every single day, so that's a different lifestyle altogether. Now, once you get into your mid-70s until your mid-80s, so between 75 and 85, you go into what I call the slow-go years. Now, you may still be healthy, but more than likely you're not going to be as healthy as you were between 65 and 75. If you were traveling during your go-go years, you may be slowing down a little bit, or you may not travel as far, or you may not travel as long, but you still may do some traveling. Now, it all depends on your health situation. If you're someone that's active, if you're someone that has been working out for years, lifting weights, walking or jogging or whatever it may be, or riding a bicycle, then you may be able to elongate those go-go years to go longer than age 75. But for the most part, go-go years are between 65 and 75, slow-go years between 75 and 85. And then obviously as your activity decreases, the cost of activity also decreases. But on the other hand, as your activity decreases, then the cost of healthcare starts to increase because you're not as healthy as you were before. So more and more of your finances are going to go toward medical expenses and so forth. Now, once you hit your mid-80s, somewhere around 85, until the day you die, that's what I call the no-go years. And basically what you're doing there is, and again, I'm just generalizing because I have clients that are in their no-go years, and they're going as hard as they did in their go-go years, but they're extremely healthy, they're in really good shape, they have the economic means to be able to do that, but for the most part, for most Americans, once you get into the no-go years, your goal is to kind of wake up on the green side of the grass every day and live to fight another day. And that happens. I have a number of clients in their early to mid 90s, and obviously when I visit with them, I can definitely see that they have slowed down because I have been doing business with them for at least 30 years, so that's important to note. So understanding how to manage not only your retirement devils, but also how to manage the last 3 rounds of life is very, very important, because you have to make certain that you don't run out of money before you run out of life. Because if you live 30 years in retirement, there's a very high probability that unless you've done proper planning, most of you listening to this podcast today are going to run out of money before you run out of life. And that's a shame, because your retirement is not going to be the same, and it's not going to be anywhere near what you thought it was going to be. Now, another area that I want to touch upon is the area of provisional income calculations. Because if you're able to manage provisional income calculations, and by the way, I would argue that if you're working with other advisors, they've never had a conversation with you regarding provisional income calculations. But if you're able to manage provisional income calculations, then you're going to do better than most Americans or most of your peers that don't even know what provisional calculations are. Well, provisional calculation is a calculation that is done, and it should be done at least every other year, but I do it for my clients every year once you start taking Social Security benefits. You see, if you take Social Security benefits and you don't pay taxes on your Social Security benefits, there's a high probability that your money's going to last anywhere between 5 and 8 years longer than if you have to pay taxes on your Social Security benefits. Now, some of you may say, Bert, I didn't think that we would have to pay taxes on Social Security benefits. And the answer or that question couldn't be further from the truth, because at the end of the day, if you don't know how to manage your retirement assets, there's a very high probability, once again, that you're going to be paying taxes on your Social Security benefits. Now, Social Security benefits are either not taxed, or they're taxed at 50%, or they're taxed at 85%. And now the question is, well, how do you know whether your retirement benefits are either going to be taxed at 50%, 85%, or not taxed at all? Well, you need to start doing provisional income calculations, and I would argue anywhere between 5 and 7 years before you retire. Because if you have large sums of money in your retirement accounts, you better start doing those calculations early enough, because otherwise the bus is going to catch up to you. And then once the bus leaves the station, it's going to be an impossibility for you to be able to reduce those tax liabilities in retirement. So when you look at Social Security benefits and the provisional income calculations, there's a formula that gets taken into consideration. And I have the software to be able to do all those calculations for my clients. But the formula is basically that if you're in retirement, you're going to take 50% of your Social Security benefits for the year. To that, you're going to add your ordinary income. Now, ordinary income could be that you retired but you continue to work full-time, or you retired and you continue to work part-time, or you decided not to work, but now you're starting to take income out of your retirement accounts, like your IRAs and your 401ks and your SEPs and your pensions and so forth. So that gets added on to that provisional income calculation. In addition to the ordinary income and 50% of your Social Security benefits, you're also going to have to add your dividends and capital gains for the year. So if you have any dividends and capital gains, and this is where tax management becomes so important when it comes to retirement planning, because that's all going to be added onto the provisional income calculation. And then last but not least would be what I call non-taxable interest. That would be primarily interest that you're generating from, let's say, municipal bonds. Now you may say, well, Bert, do I not pay taxes, or do I not get my municipal bonds tax-free? Well, most of the time you will, unless you didn't do it properly. But although you're receiving that municipal fund or those municipal bond income, federal income tax-free, that those amounts need to be added on to the provisional income calculation of your 50% of your Social Security benefits, your ordinary income, your dividends and capital gains, and then that's going to determine the overall provisional income for you once you're in retirement. And then if you go above a certain threshold, then that means that you're going to have to pay taxes on your retirement. So what would be the thresholds that you need to be worried about once you start doing your provisional income calculation? Well, the thresholds are as follows. If you happen to be single and you're filing as a single filer, then if all of those numbers that I just gave you, 50% of your Social Security benefits, your ordinary income for the year, your dividends and capital gains, and your municipal bond distribution, if all of that is less than $25,000, then your Social Security benefits will not be taxed. Now, if the income, if that entire calculation, if that income is between $25,000 and $34,000, then 50% of your Social Security benefits will be dragged into your annual income, and it will be taxed according to your tax rate or your marginal and effective tax rate. And any portion of that income that exceeds the $34,000 threshold will be taxed at 85%. So that's a big number, because if you're paying taxes on those Social Security benefits, then you're going to have to plug the hole somewhere by taking additional money from other retirement accounts, and then be able to put that money to offset those taxes in your Social Security benefits. So what if you're married? What if you're married and filing jointly? Well, you have a little bit more flexibility, because now we're dealing with two people instead of one. So if you're married filing jointly, and those calculations and the numbers in those calculations amount to something less than $32,000, then you're not going to pay taxes for your Social Security benefits. If those amounts are between $32,000 and $44,000, then 50% of your Social Security benefits will be dragged into the tax calculation, and you will be paying taxes accordingly. And then anything over $44,000, then 85% of your Social Security benefits would be dragged into the calculation for tax purposes as well. So it's very important not only to be able to manage all of your retirement devils and to manage your last 3 rounds of life with a purpose in mind and with proper mathematical calculations, but also you need to manage your provisional income if you truly want to succeed in your retirement life. Now, what are some of the things that you can do to offset that potential Social Security tax calculation or provisional income taxes on those calculations? Well, you can manage your account distributions adequately. So depending on the value of your accounts, you may want to start taking distributions out of taxable accounts sooner than later. Because if you allow your 401ks and your IRAs to continue to grow on a compounded basis, then chances are you're going to end up jeopardizing your provisional income calculation, and you're going to pay taxes on those 401k distributions and IRAs anyways, and on top of that, those distributions are going to jeopardize and force a taxation of your Social Security benefits, and many times it may actually increase the amount of Medicare premium that you will pay in retirement if your distributions are high enough for that. Now, one of the interesting things that have happened under the new tax laws is that your required minimum distributions out of your qualified plans, your IRAs and your 401ks and so forth, have been extended to age 72. If you'd recall, under the old law, you had to start taking minimum distributions out of those accounts at age 70, because otherwise you were going to have to pay a hefty penalty of 50%. So now that extension gives you an extra year and a half to 2 years to be able to allow that money to continue to grow. But although that may seem like a good idea, you have to run your numbers accordingly, because you may have to, if you want to do it the right way, you may want to start taking distributions. Forget about age 72 or age 70. You may want to start taking it sooner than that in order to offset those tax liabilities that may be coming to you at some point in time in the future. Now, RMD extension is now age 72, so the first year, every year there's going to be a factor number that is going to be automatically done for you by the financial institutions, or your accountant can do this for you. But for age 72, the factor is 25.6. So let me give you an example. Let's say you have an IRA, and the value of your IRA as of December 31st of 2021 was $500,000, $500,000. So what you would do, if you're now age 72, you would take the account value from 12/31 of 2021. So you're going to take $500,000 and you're going to divide it by the factor of 25.6, and it's going to give you a required minimum distribution of $19,531. So that means that your required distribution under the IRS code is $19,531. Now you can take more. You can take as much as you want. You can take it all if you want. Now I wouldn't recommend that, but some people do. But if you take less than the $19,531, then now the RMDs, or required minimum distribution penalties, kick in, which basically says that you're going to have to pay taxes on the amount that you should have taken out that you didn't. And on top of that, on that amount, you're going to have to pay an extra excise tax of 50% as a penalty for not taking a distribution when you were supposed to. So those are things that are very, very critical to understand, not only when you're in retirement, but as you approach age 72, because you're going to have to be able to play with the calculations, or you're going to need someone that is going to be able to help you. Someone like me, I'm a retirement strategist. This is what I do every single day for a living. So I can help you assess all of those potential liabilities and hopefully get you to live in a much, much better retirement life along those lines. Now, lastly, obviously reducing taxable account values below provisional income factors prior to age 72 would be paramount, and that's if possible. Some of you have the ability to do that. Of all these things that we've talked about, we talked about what encompasses the provisional income calculation, which would be 50% of your Social Security benefits. To that, you're going to add your ordinary income. To that, you're going to add your dividends and capital gains. And to that, you're going to add the non-taxable interest. There are basically three types of accounts that will not have a negative impact on your Social Security benefits. And those are your Roth IRAs, your Roth 401ks, and your 7702s, O2 plans, or your cash value life insurance programs. So it doesn't matter how much money you have in your Roth 401k, your Roth IRA, and or your 7702 plans. You can take as much money out of those accounts as you wish, and it would not have a negative impact on your Social Security benefits. So that's very important to understand, and it's critical to know as you start preparing for retirement. So for those of you that may want to pick my brain about this subject or anything else that we've talked about in the last 170 episodes, feel free to reach out. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for you and for your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thanks so much for giving me a few minutes of your time, and I'll talk to you soon. Take care. Bye-bye.